Should we look at Bridge Bio? Or you know what? The guy wanted me to look at Cintas. Let's look at Cintas. Cintas? I think it might be Cintas. Cintas is kind of a boring industrial manufacturer of uniforms, but like this is the kind of company you probably want to start analyzing, like something really simple. Doesn't require like a huge amount of like knowledge. You don't have to be a uniform expert to make uniforms and fire alarms. Take profit. You just, if you're long, you sell, and if you're short, you cover. Don't be that. Don't overthink it. Just do it. Yeah, it depends. If I'm gonna hurt liquidity, I don't sell all at once. But if it's a liquid position, like some large cap, and you have $2 million of it, sure, why not? Just hit sell. It's the worst that could happen. Time to go find a new stock, you know what I mean? Too many people are addicted to one stock. It really hurts them. You don't work at these companies. They don't owe you anything. There's no loyalty reward in the stock market. If you hold your stock for a year, you don't get extra shares. Did they give you extra shares for being loyal? Did I know? Did you guys are in a different market than me? Who gets extra shares? You're in the extra share program? These people who are online and they're like, oh yeah, well, you know, I've been in this stock for this many years. You get a loyalty rewards program? Yeah, it's called you get an extra helping of delusion. Cintas is like the greatest business ever. One of my favorite companies. I've studied these guys for a long time. I wanted to get into their business. It's so freaking good. This is a really good business to teach you the basics of finance. Maybe all right, cool. So Cintas is like a weird industrial company. You know, it's a really, really, really interesting company because, again, it's super easy to understand. They make uniforms. So it's really, really simple. Corporate business wants a uniform, they go to Cintas, right? It's because they're not gonna make their own uniforms. Who would want to do that? Like, you know, these uniforms are, you know, we're FedEx, we move packages, we're a logistics company, but we don't want to pay Cintas for all these uniforms. So we're just gonna go ahead and an incredible company. Yes, it's an incredible company. It can be an incredible company too if I want though. So in any event, so this is a 10Q for the period ended August 31st, 2024, which is not the standard calendar quarter. So this is for June, July, and August, which is a little weird because typically it's usually July, August, September. So it's a bit of a weird quarter, but regardless, they sold $2.5 billion of product that quarter, and it cost them $1.2 billion to make. So they had what's called gross profit of $1.2 billion, which is around half of revenue. So it's 50% gross margin, or gross profit percentage, or gross margin percentage, however you want to phrase it. There's a lot of different ways to phrase it. A lot of people don't understand margin. Some people call it markup. That's not what professionals do. So they would say the markup is 2x. You would hear that sometimes. That is not the way professionals talk. So this is a 50% margin. So 2.5 in revenue, which is 10 annually, right? 10 billion. So it's a big company. And 50% gross margin. And then you have the cost to run the business, which is SG&A. And that's only 700 million. So the profit left over is around 600, but it doesn't stop here. We do have interest. And once we add in the interest, we have something called pre-tax. And then once we add in taxes, we finally have net income. So that's the income statement. Every income statement in America looks the same, by the way. There's no special income statement that doesn't kind of start with revenue and end with profit. That's more or less what it looks like. Interest for them was negative. So they borrowed and spent more in interest than they earned on their bank accounts. Let me do it like this. And then they paid a little bit in taxes, not a lot. Bernie must be mad. And that's it. This is called Cintas. CTAS is the stock ticker. I'm gonna put it on screen. So I like this company a lot, not only because it's an amazing company, but it also is a really good tool to instruct with because it's not very complicated. And like I said, if you're a major business that needs 10,000 uniforms, you're not going to make your own uniforms. No company in their right mind, even a small business, is going to make their own uniforms. So they have to go to Cintas, and there's other companies, of course, that can make uniforms. But at the end of the day, if you want them professionally done, and it's not a crazy margin, they're only charging double what it costs to make. So it's not like they're making a fortune. Cintas is like the reliable company that gets a lot of business. So let's look at the balance sheet. The balance sheet is one of the other 3 financial statements. There's 3 total, a holy trinity. We just did the income statement for 1 quarter. We actually didn't do last year, so let's plug those in real quick. And I've built some software that can help you do this automatically, but I'm just going to do it manually because it's smart to do that for a little bit until you actually understand what's going on. And even then, I think it's probably smart to keep doing it manually, but some people, their investment strategy is a little different and they want to kind of focus on lots of different stocks. If you focus on just a handful of stocks, you should probably do everything manually. But anyway, the company, at least ostensibly, grew last quarter 7% year over year, which is not very fast. And we don't know if they had an acquisition, which would make it even less. Cash is where I start in the balance sheet. And they have 100 million here, but I spy with my eye another 300 million right here in investments. And I just lump all that together. It doesn't really matter what kind of cash it is, as long as it's cash money. It's to me, it's cash. All right, then they have accounts receivable. Accounts receivable is money your customers owe you. So, in corporate America, it's pretty different from maybe what you're used to. In corporate America, you could actually order 10,000 uniforms, receive them, and still not have paid $1. And that's where accounts receivable comes in. So their customers owe them $1.3 billion. And again, that's completely natural. Their inventories are 300-400 million. So that's product that they're going to sell, but that's also raw materials, maybe cotton, I don't know, stuff like that. Uniforms in service. So this is a little weird to me because this is a rental. So in this case, they're actually renting uniforms and other materials. So they're not even, so these they still own, therefore they have to be on their balance sheet. All of your assets have to be on your balance sheet. Enron got in trouble for something like that a while back. And here's maybe the most important asset of all, which is your hard assets. So this is property, plant, and equipment. So this is defined as, and sometimes it's called capital. It's maybe the most important line in the balance sheet in a lot of ways. This is basically the amount of equipment, property, plant, and equipment you have after depreciation. So this is any asset that you have that won't be consumed in 1 year. So this is something like even a computer that's going to be last 3 years goes into here. But more often, if it's a lot of money, it's some kind of property or plant, some kind of equipment. All right, goodwill is something I suggest people ignore, just because it's an accounting thing that doesn't really make much of a difference until you learn a little bit more about accounting. And even then, you'll be underwhelmed by what it means. It's kind of just a sort of a fictitious number. There's services contracts, which I'm not sure how they account for, but we'll just leave it there. Right of use assets is another thing I would recommend ignoring. And then finally, we have other. And so we have total assets of 9 billion. And we'll see that, well, how much is the company worth? Well, each share is $210, okay? And then how many shares are there? 403 million shares. So even though a share is $210, you haven't bought very much if you bought one share, because there's 403 million. So there's a lot of shares. And in fact, the whole company, if you bought each share for 210, ignoring the fact that the stock would probably go up as you start buying it, but ignoring that, the company would be worth $85 billion if you bought all the shares at 210. So, but keep in mind, the company's only got 9 billion of assets. So how's that possible? And last quarter, the company only made 450 million. So maybe over the course of a year, they might make 2 billion. So the company's worth 84 billion if they make 2 billion. That seems, we're gonna learn how to interpret that. You know, that's kind of the key thing here. Is that a good thing? Is that a bad thing? How do we make heads or tails of that? Okay, so those are the assets of the company, but they have liabilities too. Here are the liabilities. Accounts payable is sort of the reverse of accounts receivable. This is stuff that you've benefited from, but you haven't paid yet. Compensation and other accruals are basically expenses that you've expensed even though you haven't paid them yet. These are actually this kind of the same column, so I'm just going to add them together myself. I can do that. You can do whatever you want here. I'm also going to make just a kind of a column for taxes in general. And then I'm going to do the same thing for leases. Lease accounting is extremely complicated. I suggest you don't even think about it. Okay. Finally, we get to debt. That's probably the most important thing on the liability side. This is money that is owed to a lender. Make sure you don't confuse it with other forms of money owed. Most of the liabilities is money owed, but debt is money owed to a lender that you're usually paying interest for. All right, so cash minus debt. They have something called net cash. So they have $2 billion of negative cash. So they've got $2 billion of net debt. That means the enterprise value is around $86 billion. Enterprise value is a really important concept. EV market and market cap are very much getting at the same thing, but we look at enterprise value because we're trying to offset the kind of impact of cash. We're normalizing market cap for cash because we know that market cap, we know what cash is worth, so we can adjust the market cap accordingly. And I've made so many videos on enterprise value that if you don't understand it by now, I don't want to explain it over and over and over and over again because it gets kind of boring. All right, but yeah, if you don't understand what enterprise value is, please do. For the thing for Cintas is 85 billion and 87 billion are pretty similar. So enterprise value and market cap are so close that it's not going to matter. EV is the preferred measure, but market cap's easier to understand. And cash and debt are just valued at the dollar amount for each. So you can just basically say, well, I'm paying 87 billion for Cintas because even though it's 85 billion for all the shares, I'm not getting much cash and I have to pay off more debt. So it's really 87. So you're just adjusting. And it can be a little bit tricky to get used to that idea. Some people get it right away, other people don't. And so now we come to the last of the three financial statements. We got the Father, the Son, the Holy Spirit, the balance sheet, income statement, and cash flow statement. So the cash flow statement just recasts the income statement. So here's the income statement. And the income statement said that, at least according to us, but also according to them, because we make our own personal adjustments. But in this case, we didn't do any adjusting because Cintas is actually a really simple company. The company made around 500 million. So how are we trying to figure out another way to look at this? Because this includes a bunch of accounting stuff. And we really just want to know how much money did we make. And that's what the cash flow statement tells us. And we adjust for all kinds of things. And the spoiler alert for this company is, at least for this quarter, they're basically the same amount. But a lot of times you'll have cash flow a lot bigger than net income. And sometimes you'll have net income a lot bigger than cash flow. And you kind of have to understand why that's happening, I think, in my opinion, to really understand business. And these videos won't just help you become a better investor. I think they'll also just help you become a better business person, which is probably more important in a lot of ways. So the cash flow statement basically reconciles all these little adjustments. And after reconciling all these adjustments, we can see the cash flow number actually didn't change very much. It went from 450 million to 460 million. Not much, or 470. So this is after we adjust depreciation. This is after we adjust this amortization, stock-based compensation, deferred taxes, and all the other working capital adjustments. But there's another thing called capital expenditures. We sometimes just call it CapEx. And here, Cintas spent a bunch of money upgrading their plants and property. And there's something called free cash flow, which is basically cash flow from operations plus CapEx. And now we're at 374. So net income is actually quite a bit higher than free cash flow. And this is just one quarter, so it doesn't matter that much, but it's something to keep in mind. They also made some investments, some acquisitions, other things like that. we just have to keep all that in mind. So we can see that the company's cash went down over the course of this quarter, which is fine. They're a huge company, so the cash going down $241 million is not a big deal to them. I call that change in cash. This was FX, financing, buyback, and other. Okay, so we sort of completed one full quarter here, and we just have to complete more and more quarters, which is, you know, a little laborious. And again, you can use this tool that I created so that you can do that a little more quickly. Just checking in on some of my other stocks. Ooh, 𝗬𝗏 is up a ton. That's a good shorting opportunity because 𝗬𝗏 is kind of like a fraudulent company. And one of the things I really focus on is shorting because, you know, a lot of people get fooled into thinking stocks only go up. They don't only go up. There's some easy to spot, and that allows you to reduce your beta exposure, which is really helpful because markets don't always go up either. I like this stock a lot, 𝗓𝗏. We'll see what happens. It should be bouncing back at some point soon, hopefully. HIMS is up 10%. Wow, let's go HIMS. So now I'm going to go to the next 10Q. So the next 10Q is in the form of a 10K, and why not? Let's just open that up. The 10K is a lot more detailed than 10Q. Okay, so the 10K for Cintas is going to have all of the details for the company. It's much more detailed than the 10Q. And so if you pull up the 10Q or 10K on Godel, it's a lot faster in my opinion than pulling it up on the SEC website. There's a ton of details about the company. They were founded in 1968. They were a laundry business. Sort of goes to show you the American dream, right? Your family has a little laundry business. You turn into one of the biggest companies ever. It's a little complicated. Stocks tend to follow earnings over time. Sometimes the market misses kind of the value of a company. So if there's one section you can skip in a 10K, there really aren't any, but you can kind of skip the risk factor section. If you had to skip one section, I don't recommend skipping it, but it is something you can skip if you have to skip something. 𝗓𝗏 is not under investigation. What are you talking about? Yeah, the class action lawyers are, yeah, there's class action attorneys for every single time a stock goes up or down. There's a class action, quote unquote, investigation or a class action lawsuit. So please, if you're brand new to the stock market, don't just write random stuff in chat, or I'm going to put you under investigation. My law firm has decided to investigate you. Anytime a stock goes down like 10 or 20%, there's 15 law firms that file press releases that want to do a class action. But if you just look at the news, just press N in Godel, and you can see we actually hide all the class action lawsuits. Turn off only company news. I think you can see them. And basically, let's see, you'll see like, oh, here we go. Pick any stock that's gone down. I don't know. Let's pick, what stock's gone down recently? I don't know. Anytime a stock goes down at all, there's so-and-so investigates for class action. This is all the news of the world scrolling down at your fingertips. Yeah, sometimes it's so bad that the entire like news section is all investigations from fake law firms. Like a law firm can't investigate you. Like that's not a thing. Like it's such a fake press release. Yeah, you know who the worst is? There's two big firms that do it. 𝗢𝗢𝗡𝗢𝗢 and 𝗕𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗢𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙𝗙 Look at this. Press release on every single company. Look how many companies. Stellantis, Dexcom. These are like all big companies too. ST Micro, Sage, Verve, Starbucks. Oh no, Levi and Korsinski is going to take down Starbucks. Whatever were we going to do? Oh no, they're going after UPS. How are we going to deliver our packages again? Elanco Animal Health. What's going to happen? They're going to stop us from getting our animal drugs. Levi and Korsinski is going to take over all of these companies. You got like 8 people. These guys are the bosses. Look at these guys. These 2 guys are going to end your business. There's another one, Faruqi and Faruqi. These guys are even meaner. They're like gangs. Lordstown Motors, Luminar. These are all bag holder stocks. Ampio, Splunk, Revance, Peloton. Oh man, they're going to ruin Peloton. Is over. Anyway, if you think the class action thing matters, then you know this is not the channel for you. Basically, you can sue anyone. It costs $20 for you to sue somebody, and then they settle the class action for like a couple million, and the D&O insurance pays for that, and then you got to pay more D&O insurance premiums. It's pretty simple. Anyway, these are the 10K has the annual statements. So the annual statements will give you the full 12 months. And you can see they grew revenue from 7 billion to 8 billion to 9 billion. So pretty good modest growth. And then you can see the gross margin. Well, let's calculate it, I guess. Is it actually low? And then wrong number. There we go. Okay. Yeah, their gross margin's a little under 50%. Okay, so 46, 47, 49. Okay, so now we have the annual picture. We just looked at a quarter for Cintas, and now we have the annual picture, which is a lot more interesting. We have 2022, 2023, and 2024. And there's a lot more data here. So we can see that the gross profit, which is, again, the cost after actually making the uniform, the profit left over after the cost of making the uniform, 3 or 4 billion, then 4 billion, then 4.5 billion. Pretty good. And then after the cost of running the business, well, what's that? Salespeople. That's salespeople. That's lawyers. That's accountants. That's all kinds of folks like that. Marketing plans, advertising, you know, you name it. Everything else other than the cost of the actual business, you have profits left over of around 1.5 billion, then 1.8 billion, then 2.1 billion. So profits going up. Cool, but we still haven't factored in interest. So this company pays interest on its bonds, as you must. If you're going to issue bonds, you're going to pay interest on them. So they lose a little money there. They also make a little bit money on the cash that they own, but they don't make too much on that, apparently. And then finally, they pay taxes. So here's the taxes they pay, which is pretty significant. And they're left with 1.2, then 1.3, then 1.6 in earnings. Okay, so that's their earnings. So why is that company worth $87 billion? That seems like a lot for, let's say last year, they made 1.6 billion. So how many years would it take for you to get your money back? 54 years. Does that make sense? If I started a business and then I said, I want to sell you the business. And you say, cool, well, how much money does the company make? And I tell you how much. And then you divide by my asking price and you say, it's going to take me 54 years to get my money back? I say, well, not really, actually, because earnings are going up. Well, how much are earnings going up? Well, let's take a look. Net income, at least, went up by 9%, then it went up by 17%. So let's take the average, 13%. If income goes up by 13% every year, how long will it be till we make 80 billion back? Well, let's count. It's for sale right now in the stock market at 87 billion. Okay, so we add this plus this, and we keep accumulating, and I think this will give us the answer. All right, so it looks like around right here, it looks like 16 years. Yeah, 16 years before we make our money back. Does that make sense? Could you find something cheaper or something better? I don't know. That's the art of finance. We actually don't know how many years it'll take because we're guessing. We're guessing as to what's going to happen in the future. And that's what's called forecasting. So we don't actually know how many years it'll take. In the stock market right now, you can look at the average amount. Right now, it's around 20 times is the average amount. So 56 times current year earnings or next year's earnings is, you know, kind of a lot. But let's look at the cash flow statement too, because that's rather important. And nice thing here is we can look at it kind of all at once, and we can see that maybe they made a little more cash flow than income, or maybe not. We'll see. So roughly the same. Net income looks like it tracked free cash flow pretty well. So they do have a monopoly. So one of the ways to think about this is discounting. How many years it'll take to get the money back, and then how certain are we that we are going to get the money back at all? That's an important question. My guess is for this year, they'll probably make around 2 billion. And then they'll make, I don't know, 10% for 5 years, and then 5% for 5 more years, and then say they'll grow at 3% forever. So this is a pretty simple forecast. It's really like too stupid to be useful in a lot of ways. But I'm providing this forecast, which normally we should do by looking at the industry, how much is the industry growing, what kind of margins can they have in the future, things like that. But I'm just going to do this discount rate. And so what's interesting about this is I can discount future cash flows, and this is something every finance student learns how to do. And I get 53 billion. If my forecasts, which are really conservative, if my forecasts come true, I get 53 billion, which is less than 87 billion. So we're using the basic tool of finance to sort of decide, well, is this the right price that I want to pay for the stock? Now, more realistically, the company will grow like this. It's a really well-run company, and it's probably going to grow in a pretty healthy amount for a long time to come. They have all kinds of tools to grow, including acquisitions. And now if I do the NPV, it's almost exactly the same as the stock price, which is kind of crazy. And now if I change the discount rate, in forecasting, unfortunately we kind of have to make assumptions. But if I change the discount rate, say to 7, now the company's worth 111 billion, which is actually a decent improvement from the current price at 87. With that kind of discount rate, maybe you want to buy the stock. But at 6% discount rate, you're looking at, an unbelievable opportunity, right? It's almost like a double. At a 5% discount rate, it's really a great long. But the question is, what do these discount rates mean? You're basically saying that I'm counting this year of net income of 2.3 billion. I'm only discounting that by 5% 2 times. So I'm treating this like I already have 2.1 billion. That may sound okay. But what about this year of net income? I think I'm going to get 2.6 billion in 2027, but I'm going to count it as if I already have gotten 2.2 billion. Well, that's 3 years from now. Is 5% the right number? And this lets us, by changing this, it lets us decide how much are we going to count on those cash flows from the future. And unfortunately, at the very bottom, inflation is 3%. So we have to discount by at least inflation, right? And then we have to discount at least by something called equity risk premium, because these cash flows are not guaranteed to us. Yes, we're part owner of the company, but there's a lot of issues. We have debt. Those are those cash flows, for example, are guaranteed to the bondholders by law. Our cash flows are not really guaranteed to us until we pay the bondholders. So a lot of people say there's an equity risk premium, and that's like 3 or 4%. Then we have a risk related to just this company. And even though Cintas is a really great company, well, they only really do uniforms. So at the end of the day, it's not like they have a really diversified business where like they're doing 100 different things. They make uniforms, and the uniform business could not go great. Something could change in the uniform industry. Maybe robots take over for workers that need uniforms, and now all of a sudden the need for uniforms is going to decline. And when we're going to tell our kids, back in the day, there used to be something called a uniform, the kids are going to be like, wow, that's crazy. Everyone at Best Buy wore the same thing. And that's something that, who knows, maybe that'll be the future and we won't need uniforms. So the risk to the company is probably higher than your average diversified company. So that's something to sort of think about. So as we forecast, we try to, get a sense for kind of the value of the business. And we don't look at the model, the spreadsheets we make, as like determinative of anything. Like anybody can pump some numbers into these things and try to decide what the company's worth. That's not really maybe the best way to do it. I know some beginning value investors think of it this way, and I think that that's not really the goal that I have. The goal is I want to really understand the company, and then try to make some assumptions and thoughts that are unique. The point is that we're going to try to forecast revenue, then we're going to try to forecast our costs, and then we're going to look at net income. But net income will be a function of all of these inputs. So I'm going back a couple more 10Ks just to get a couple more years together. And we can see the picture of this company a little bit better. And I'm not doing tons of work here, but just a tiny bit. We can see they had kind of a slow year in 2021. Revenue barely went up at all. So that's kind of something that's a bit of a warning. That can happen to Cintas. It does happen sometimes. But even in that year, they grew earnings a lot. So the revenue didn't grow much, but earnings grew a lot. That can happen. Typically, revenue growth is required for earnings growth, but that is something to think about. And it's really fun for me to see how the company kind of progressed over time. If you find that kind of stuff to be fun, stock market's for you. If you think it's boring, probably need a new hobby or a new job. To me, it's really cool to see how these big companies maneuver and they try to grow. You can see that they're not a fast-growing company, as you can imagine. I mean, it really just is a 7% grower, and that's even with some acquisitions sprinkled in, which is not organic growth. So they kind of grow like GDP. I mean, it's a little faster than GDP, obviously, it's 7%, but you should not expect blazing fast growth like you would from Palantir or, you know, some other company, Datadog or fast-growing biotech company. Like, that's not what this company is. And they sell things other than uniforms, by the way. Uniforms are on half their business. So they do sell smoke detectors and like mats and like stuff for like any business, like office building, basically. That's kind of where they expanded their business into. Okay. And again, you can see earnings kind of growing fairly rapidly, at least more rapidly than revenue. So earnings grow 12% on average, revenue is growing 7% on average, but earnings is what we keep as shareholders, right? So 12% a year is really good. Think about a bond. Does a bond grow its coupon? No, it's the same coupon every year. When you buy a bond, when you buy a $1,000 bond, you might get $50. It's 20 times earnings, if you think about it that way, right? So let's compare a bond to Cintas. And there's the bond market's bigger than the stock market. So a bond is $1,000, coupon's 50. And so if you think about it, you can think about it as yield. This is the yield, right? 5%. But you can also think of it as earnings ratio. This is how many times I need to get this coupon before I get my money back. Now, of course, in a bond, you also get your principal back, but it's still worth thinking about that. And so for this company, Cintas, it's 884, 560. I think we said 2,000 is our coupon. This is our net income, our earnings. So we can do the same exact ratios here. And you can see that Cintas is yielding much less. The earnings are going to grow. These are growing 12% a year. So eventually your yield will actually catch up. Now bonds are a little more certain, as is being pointed out. That's right. Bonds have like almost, well, they have basically a legal claim on the cash flow. But this is the whole idea, is that this coupon's never going to change, right? This 5% bond, 30, 40, 50 years from now, wherever maturity is, it's still going to be the same. But here, this is going to change. You can see that the yield right here, after, how many years is this? This is year 1. After just 8 years, that's it, 8 years, you're getting a better yield than the bond. That's kind of crazy, right? After 15 years, the company would be yielding 12% if the price of the stock never changed. So really, really crazy kind of finding here is that with compounding earnings, make bonds look quite boring. Again, bonds have certainty. Cintas could be bankrupt by then. We don't know. The company's been around a long time. It seems really well managed, but nothing's stopping them from doing something crazy. When you own a bond, you know, you can go sue the company and you can go repossess your assets. Like, you know, you can stop the company from doing something crazy. You have rights that a stockholder just doesn't have. But again, for at least these 7 years, they grew every year. Bonds are really traded mostly by professionals, but you can trade them on Interactive. And if you leverage, you can trade bonds and make them very exciting with leverage.